risk-free treasury assets, but they have an inflation component. So if you think about, if I said to you guys, right, I'll give you two products you can buy. I'll give you a growth stock like tech, for example, XLK, and I'll give you a dividend stock. I'll give you a dividend stock. So perhaps the Dividend Kings type stocks, one of those types of things. And you've got a choice. Now you can obviously look at those and say, well, when does one of those markets outperform the other? What kind of situation in the background would one be looking for one asset over another? Well, tips are exactly the same. If you're trying to think about whether you want to buy a treasury bond because you have a balanced portfolio, for example, if you've got a balanced portfolio and 50% is in equities and 50% is in bonds, tips make up that 50% that's in bonds, don't they? They are part of that bond equation. And if they're part of that bond equation, of course, then you've got a choice. Out of that 50% of US Treasuries, what percentage do I want in tips? And what percentage do I want in Treasury bonds? Well, why would you make that decision? How would you make that decision? Well, you're viewing inflation, of course. If you believe inflation is going to go higher, you would probably be more likely to be buying tips because it's going to offset because the yield that you buy it at is now fixed. When you buy a bond, that's the yield fixed. So if you think inflation is going to go higher, you'll buy tips. Now, it doesn't mean bond prices are going to go higher. It means inflation is going to go higher. So you're buying tips because the downside on tips is going to be a lot less than the downside on bonds. So you buy tips for your portfolio when you believe inflation is going to go higher. And that's what you start paying attention to, isn't it? That's what you start actually paying attention to. So if you think inflation is going to go higher, you buy tips and you sell treasuries. Perfect. Perfect. So that's what we start looking for. That's what we start looking at. So one of the key aspects to that is we simply look and see whether that's because they're seeing inflation going higher or whether they're predicting inflation going higher. Because if they've seen inflation going higher, then the trade's probably too late to make any money out of. But if they're moving into a position before inflation, now I'm excited because I'm seeing that relationship showing up before inflation even moves. That's significant, surely. So when we look at, for example, a 15-minute chart of tips against bonds, this is the US tips so that we don't have any euro-dollar calculations to do. You'll see that they both go in the same direction most of the time, but there's two very distinct differences in valuations, isn't there? There's a very distinct difference in the valuation through this phase, and there's a very distinct difference in valuation through this phase. You can see the two valuations are completely opposite from each other. Now, I don't know yet if this is a forecast for inflation or whether it's a traded inflation. The inflation might already be gone, but it might be a forecast. If it's a forecast, we've got a lot more opportunity. If it's already been traded, the opportunity is limited. It's basically going to be a spread. Think about it. If it's traded, it's going to be a spread. So that's going to take away the opportunity, isn't it? That's going to take away the opportunity for us to make money. So in other words, when the tips are trading at a premium to bonds, that tells me that there is an inflation element to trading. This is trading like inflation because they're buying a lot more tips than they are treasuries. So this is, to me, this is an inflation phase. Now that doesn't mean that the bond price is going to collapse, because obviously the bond price has already collapsed in some respects. The bond price has already collapsed here, so that's trading inflation. Now is that forecasting inflation or is it trading inflation? If it's forecasting inflation, obviously we can start to recognize that this is a very, very early call on oil, for example. We could take advantage of selling, in this case, buying some oil product. Now, obviously, when they start buying bonds here and they're not buying tips, what does that tell me? Deflation. That tells me that there's an element of deflation on a macro scale basis here. Now, is that a forecast or is it traded? Is it a forecast or is it traded? And that's what we start investigating. Now that's what the big questions are every time we look at bonds. So this is something that we can start to look into in terms of what for example, what the oil prices are doing. So when we look at oil prices, this is forecasting inflation. Look at what happened to oil prices. Oil prices went straight up. So this was a forecast, wasn't it? This was a forecast of oil prices to go higher. Oil prices had been bouncing along a bottom edge here. The price was $68. Oil prices rallied from $68 to $72 for $4,500 profit from that bond forecast. $4,500 profit from that bond forecast. It's crazy, isn't it? But what is this telling us? This is telling us that there's deflation. Well, no shit, Sherlock. We've already seen oil prices dropping. So that's probably what you can see, the idea that if oil prices are dropping, the TIPS market should be trading at a discount to oil, which they are. So it's accurate, right? Everything's accurate at this stage. Just like fair value reads. The idea of oil prices starting to rally, of course, that leaves the TIPS markets behind down here. So there's going to be adjustments in the TIPS markets, isn't it? But if the TIPS markets don't start adjusting, what does that tell you about this uptick in oil? It tells you that an uptick in oil could be a big opportunity to make a lot of money, right? It tells me, personally, it tells me that if anytime the oil ticks up again into these areas, there's a great opportunity to be short oil because the bond traders aren't seemingly interested in what the oil's doing. So that opens a door to an investigation, doesn't it? That opens a door to investigation. Now, there are opportunities, as I said, from the bond perspective, there's opportunities. For example, if you were on a spread desk, if you were trading this as a spread market, you were trading these three products, half of your money went into the oil product and half of your money went into fixed income. This is the way I want you to think about the TIPS markets. If half your money goes into fixed income, what would you do with this trade? Well, personally, with oil prices rising like this, and I can see the TIPS markets is at the bottom edge, that's telling me that nobody's buying TIPS. What I would be doing is I would buy TIPS, I would sell US Treasuries, and I would sell oil prices. So I would sell my US Treasuries and end up buying TIPS with the money that I sold my USTs with. And I would offset that by a sell on oil. Sell on oil. And that's the basics of the trade. That's the basics of that bit of business up here. That's what you're looking at, right? That's how you start analyzing this process. So you can see, for example, here, you could look at the TIPS markets here, and you could see the US Treasuries going higher. Well, that tells me something. That drop in the TIPS markets there tells me that there is a very, very strong suggestion that oil prices are going to do what I'm suggesting over here. If you look in the background here, you'll see that oil prices should be selling at higher prices. Oil prices did sell at higher prices. You can see oil prices dropped off really, really nicely. So you start to recognize the opportunity as a global macro fund trader, for example. You can start to see why you would buy TIPS, why you would buy bonds, and why you would sell oil, or whatever combination of the three. But you can't look at them in isolation. That's the problem. It's not the kind of market that you can look at in terms of isolation. You can't say, I'm going to buy TIPS. Why would you buy TIPS if the markets for treasuries are bearish? You have to think about it beyond that situation. You would never, ever buy TIPS as an isolated example because you're buying TIPS because you think it's higher inflation. What the hell are you buying any treasury bonds for if you think it's higher inflation? Well, the downside for big institutions is they have to buy TIPS because they've got to have a 50-50 balanced portfolio. All these guys that have a balanced portfolio to manage, they don't have a choice. They've got to buy one of the treasury products, right? They've got to buy one of the treasury products. So when you look at when you look at what they buy, so when you see bonds rising and you see the TIPS kind of falling here, and you ask the question, what are these guys trading? Why did they buy treasuries and sell TIPS? They must be thinking that inflation must be falling. So in this environment here, all I want to be doing is sell oil. All I want to be doing is getting short oil positions. And therefore, for me, in this type of environment here, I want to sell top edge oil. In this environment here, I want to sell top edge oil. In this environment here, I want to be buying bottom edge oil. It's an oil trade rather than particularly a bond trade, but we offset that by looking then at what that's going to do if oil does then buy, what that's going to do to bond prices in general. So this is a bit of guidance about what's expected to happen or what's already happened. Obviously, if oil prices are very, very low and tips are very low and the bond price is very high, it's just doing what we expect. And we're looking for that reversion. We're looking for that change in behavior between bonds and oil and the tips markets. It's always about trying to understand whether it's already been traded or trying to get into the trade because it's not yet actually been traded. And we do this on a micro scale basis and we do this on a macro scale basis. Now on a macro scale basis, of course, on a micro scale basis, we don't have any tips markets trading in the London session from the US. So we basically we're left with the US, the UK tips, the European tips. So we've got to be able to look at the European markets with the same eye from 8 o'clock onwards. So if I get rid of oil prices and I look at the European markets from 8 o'clock onwards, my big question, of course, is number one is what's the macro in it, but number two, what else is there for me to work with? If I look at the European markets and I see this is obviously the same gap down that we were talking about here, but I can watch what's happening inside this environment. So I'm already aware that this is massively discounted against this. If we look in the background, you will understand that. It's massively discounted against bond prices. So there's a big suggestion of selling loads and loads of oil or buying loads and loads and loads of tips. So that's one of the things that we could have anticipated in the tips markets. It's the best inflation hedge trade you can get, isn't it? It's the best inflation hedge trade by a mile is the tips, but you guys don't trade tips unless you're going to start trading the tips markets itself in an ETF, for example. You start buying tips or TipX or what's the other one? TipX. It's going right out my head. TipZ as well, and then just TIP. So into the day itself, we're always asking that question. Why did somebody buy tips here? Why was somebody buying tips? Well, that's all part of that unwind, because that unwind always takes place at 1 o'clock. Because that's when the volume comes in, right? That's when the bond volume comes in. So the unwind is usually at 1 o'clock. So when I've got this amount of macro, that unwind at 1 o'clock isn't a surprise. It was exactly the same the other day. You can see as the volume started to build in bonds, there was this big unwind right there. As the volume built in bonds, there was this big unwind right there because it's too cheap. The idea of this is that oil prices should be collapsing, and if oil prices don't collapse, that's going to get a big buyer coming in. If oil prices don't collapse, that's going to get a big buyer coming in. And if oil prices kept not collapsing, the tips markets will start overtaking the bond markets because people will keep buying them. People will keep buying the tips part of the curve. People will keep buying these trades here because that's what's starting to set up, right? So sometimes it's dead obvious and sometimes it's not so obvious. You can see there's a great example of the twist in the curve here between inflation and and bond prices. You can see that twist in there, for example. You saw the tips markets getting sold and the bond markets getting bought. Well, that's obviously that's a big sell on oil, isn't it? That's got to be a big sell on oil coming up at that stage. Either that or oil is already selling off big style. And that's why the bond prices went up. So that's something you can look at. If oil prices hadn't already played, if oil prices hadn't already sold off, that would be a brilliant oil trade right there. Brilliant oil trade. But that's what we play with. This is how we analyze this picture, isn't it? That's how we go about analyzing this. You can see the tips markets get a lot heavier selling here into that low price than the bond price did. But that's got to be bullish oil. Why? Bullish bonds. Why? Well, because the tips are a lot more sold than the bond price. Why would that happen? Lower inflation. So that's suggesting that picture there is suggesting a sell on oil, isn't it? That's suggesting a definite sell on oil through that phase, probably from about here. So that's suggesting a sell on oil at that stage. So what happened to oil? the oil prices rallied up to the top edge from that point onwards, and then did sell, sold off the oil price beautifully. Fantastic outcome. So what is that all about? Well, that's exactly what you would have expected to see from what was happening in terms of the TIPS bond narrative. Now, when we look at the current narrative, what does it look like? It looks like they're still selling TIPS and it looks like they're buying bonds. What does that mean? If they're still selling TIPS and they're still buying bonds, what are you thinking? Lower inflation. You're thinking lower inflation. So what you're going to be thinking is, well, I should still be able to make money by selling top edge oil prices at the moment. That's still the narrative that's setting up because of this. Now, we've got more accurate information to use because at this stage now, we've got the US TIPS markets and we can start getting rid of the euro component of this. So when we get rid of the euro component, we start asking the question, what is the overall shape of this market? And what this shape of the market suggests is bond prices will be going higher still. So there's another opportunity to buy some bonds just in there in the last few minutes off the low price. This is pushing. Remember, this is now the actual break-evens. This is break-evens, not TIPS. So this is inflation break-evens now showing up for that higher price, suggesting that oil prices are going to continue falling. When we look at the inflation break-evens, this should be a lot lower, and it is a lot lower. It's significantly a lot lower. As the bond price rallied, the TIPS price never moved, suggesting that there is an expected sell-off on oil prices pending. I am very bullish bonds. I want to be long bonds for the squeeze at the top edge. I want to stay on that long side of the book to try and keep that squeeze going. And obviously that's the objective of this current trade, is to try and rip this price right through the top edge off of this uptick. And that should be a big sell on oil. Now, the only thing that's offsetting that sell on oil just now is this rally that we talked about on this euro dollar. This big rally in the euro dollar is giving you a bit of a balance, a bit of an impact on the oil price. And that's why oil prices haven't been able to sell off just yet. So there's always that counteracting signal. There's always that going to be that extra pressure coming from somewhere else that's just allowing oil to hold on to its gains. But if that euro dollar does start to flatten out and start to sell off, that oil price should, the way that the bond price is trading, should come tumbling back down again off the high price. And that's what we're trading just now. That's why I've been predominantly working on the short side. I still want to see 72 traded on oil to get that bit of business done at oil at higher prices, but it's not happened yet. Makes sense to everybody? A little bit complicated? I don't think so. But it's just something you've got to keep working on, isn't it? It's something you've got to keep trying just to find out a couple of clues about what's happening, isn't it? It's just about that process. It's always just about the process. Anyway, there was curve opportunities, by the way, to sell bonds at the top edge at around about 4s or 5s. I'll show you that in a second. But this is the curve opportunity to sell bonds at the top edge. You'll see that the belly of the curve dropped nicely, and the FOB spread managed to rise nicely. You saw that the knob spread, which cannot rise, it's impossible for the knob spread to rise if you're going to sell the bonds. If it does, forget about it. And you can see what happened in here. There was a divergence here on the knob spread as the FOB went higher, so that's good news. The only challenge you had was that there was no recent reference. There wasn't like a reference 2 candles ago or 5 candles ago. And obviously you're trying to find an idea behind where the level is to deal against. Well, that's a tough one because there isn't a natural level. So you've got to kind of lean against perhaps the big deltas that were pouring in at that stage and just watch for those big deltas getting absorbed as the curve traders take advantage of that opportunity. So when that started to jam up in here, you can see that there was a flat top on the FOB spread just here, and that allowed you to maybe draw a line at 0.3. As the price traded forward, that was your opportunity to start selling passively into that. Now, it's not great, but it still manages to capture enough of that trade. Now, remember, the other side of the trade was bullish, so that pushed the price back up again, and you can see another divergence. The guy's buying the fight spread at the bottom edge, pushing the price up. The guy's buying the fight spread at the bottom edge, pushing the price up. Selling the bond again back into that is against the curve is the right trade to be doing just now. But remember, against inflation break-evens, you can be and should be buying bonds down here. Buying bonds down here. That's what you should be doing. Now, the reason why this is a good trade is because that actually took one tick above the previous. Remember, I keep talking about that that idea of the passive trader is trying to find those passive little levels. Now, when it takes out that little ledge, you know, you're obviously going to be watching for a lean, you're going to be watching for something, but it really is a passive trade. You want to be putting in sell limits as it comes up into those areas. You want to put in sell limits and get filled on those, because if you chase that, a lot of the times you're going to get stuck. You can't afford to chase curve trades. You can afford to chase Forex against the bonds. You can afford to chase oil against the bonds. You can afford to chase the absolutes against the bonds. You can afford to chase the bonds in every one of those other occasions, but you can't afford to chase the curve against the bonds. It's a stupid thing because you're not understanding the concept of the grail. If you don't understand the concept of the grail, you're going to make bad mistakes. So you sit passively, and if you get filled, you get filled. And that's a very, very nice, easy, quick sell off the top edge here. But you've got to remember, you're still trading against those absolutes, guys. We still think oil prices are opportunities to sell at top edges. The only concern, as I said, is this high-priced euro, that weaker dollar. That's what you've got to be concerned about as a bond seller at the top edge. It's a good trade, but it's not a brilliant trade. So this is why this isn't a brilliant trade. You can see that there's a lot of selling on the tips markets. There's a lot of people think that there is a problem brewing in oil or inflation. There's a lot of people think there's a problem brewing. And that might be something that's going to come from the Fed. Remember, people positioning for the Fed this afternoon at 6 o'clock. 7 o'clock, sorry. People starting to position for the 7 o'clock Fed tonight. People thinking, of course, if they're selling tips and buying bonds, they think the Fed's going to be what? Hawkish or dovish? If they're selling tips and buying bonds, what do you think the market's opinion is of the Fed? Hawkish or dovish? Dovish, right? Because if the blue line is trading at a discount to the candlesticks, that suggests a lower outlook on inflation, a lower outlook on inflation. So a lower outlook on inflation is dovish. So that's what this is what this tells us at this point, is that this has got a dovish outlook on inflation. Does that tie in with equities going higher, however? Does that dovish outlook by the Fed tie in with a higher priced equity? Yes, it does, actually. Because we all know that equities hate the hawks and the Fed, right? Equities detest the hawks and the Fed. So a lot of people wonder, when bonds go higher and equities go higher, that doesn't seem to make sense to a lot of people. But when we think about the dovishness of this, and we look at the equity going straight up like that, this actually makes perfect sense from a fundamental trade point of view, doesn't it? Higher equities and higher bonds is exactly what you would get from a dovish Fed. If we got a hawkish Fed, we'd expect lower bond prices and lower equity prices. So this is probably tying in perfectly with each other. The buy on bonds, the buy on equities, they tie in together with the same dovish Fed narrative, right? It's pretty obvious if you just go through the process, guys, yeah? I beat you that time, Cliff. Oh, no, I never beat you that time. I thought you'd written 85s. I got 87s. Absolute ride. Cheers, Cliff.